bring in our next guest analyst. Let's bring him in. It's Mr. Craig Bolanos. He's with VestGen Wealth Partners. He's a co-founder there and an advisor. Thanks for being on the show up in Chicago. Usually we have a really big number to talk about. Well, we don't have that here today, but we did get some earnings overnight, Amazon and Apple. What are your thoughts macro-wise? We've had some Meta and Microsoft earnings as well. A little bit of a turnaround. We were getting beat up early. I don't know. I don't want to take all the talking points up, but what are your thoughts here?
Well, you're not stealing the talking points. Thank heavens for Microsoft's rally. I mean, there's a core component of the Mag 7 that was redefining the Lag 7 this year. At least we're getting back to even. And with Amazon's bump, that stock's going to be positive too year to date. Now, if we can just get Tesla and Meta to participate, life's going to be a little bit better. Clearly, this market's in the show me phase. It's not just about how much you're doing on CapEx. It's whether or not the capital expenditure appears to be responsible to those investors who want to make sure we don't get over levered into the spend without being able to deliver the results. Sure, am I disappointed we're absent any news on a Friday? You know I love your program, but the Fed gave us plenty in Kevin Warsh's second meeting at the pulpit this week.
All right. Yes, they did. And I want to ask you what your gut instinct is on interest rates, because not whether they should raise them or lower them, but we've got the 10-year yield and that 30-year that are stubbornly high, and today the 10-year yield is actually squeezing a little bit higher. Some want to blame it on the specter of maybe some future rate hikes around the corner. I don't think they're going to hike. I think that we're all worried about it, but others, and probably folks that I talk to, a little bit more, are really saying that this is a reflection of our borrowing and spending. Where do you land on those two camps?
I'm actually getting a little nervous about a one-time rate hike. I mean, Scott, here I was sitting in January and early February prior to oil prices having the oil shock leading to the inflation spike. I was thinking we were going to get 1 to 2 cuts in the fourth quarter because I thought the labor market would actually start deteriorating because I thought the AI would start taking jobs. Clearly, here I am. We're coming into August, and I'm a little nervous about a 1 rate hike between now and the end of the year. Why? I got a Fed that's more quiet. I got a Fed that's more humble. I got a Fed that wants us to guess what's happening. A Federal Reserve who said, hey, dot plot, forget it. We're not going to give it to you. The market doesn't have the Fed as crutch anymore. True. I mean, this is back to the early Greenspan days, my friend, where we're going to be watching to see how big his portfolio is as he goes up and down the steps to determine what the policy is going to be. So none of that is bad. Kevin Warsh will be great. It's just a little bit of a risk because he's new and he hasn't been tested yet. But I'm sorry, your question is what's causing it? Simple. Unsustainable fiscal spending from our government.
Bingo.
And in addition to that, I believe AI long-term is deflationary, but you can't deny,
I agree,
when you have hyperscalers pumping this much money in capital expenditure, 4x what it was 3 years ago, that's a lot of money chasing a few number of semiconductors and goods.
You're exactly right, and I can't agree more with you. And look, I've been doing it a long time. This is my 39th year. I'm going to be rounding the corner on 40 years coming up here. And I cut my teeth in the Greenspan era, and I'm glad I did, because you had to do your own homework, and you had to have a view, and you had to have it, be able to back it up with some good facts. Since 2008, the Fed has been too involved in our back pockets, and they have been manipulating asset prices because they just haven't let the market go lower. They've always been there to rescue it. So if you take a look at a chart of the S&P going back, say, just 40 or 50 years, when we hit 2008, 2009, it goes straight up because they basically implied we're not letting the market go down anymore. And in order to get out of that free, that punch bowl kind of free candy environment, they're going to have to normalize. That's what I've been calling it, normalize. Now, it's going to be a little painful. I don't know how much they're going to do as far as actually rate moves. They maybe do something with the balance sheet and the likes. And you know what? By the way, I would say the bond market's doing a lot of the Fed's work for it right now anyway. So they probably don't have to touch. If we continue to see these rates hang at these levels, they can let things run as they are. And also, the Fed's going to want to have probably a little bit of a bias to higher inflation, just because we are in such debt, and they're going to be trying to, say, inflate our way out of it. So I'm looking forward to getting back to the way it used to be because, I say it a lot on the show. I was an adjunct professor of finance at DePaul University in Chicago by you there, Craig. I've spent my life in finance. I was a finance major at the University of Colorado. I've traded on the floors of Europe's exchanges as well as the U.S. And I've never been more embarrassed about my profession when they brought out that dot plot thing. That is the dumbest thing I've ever seen in my entire life. And it was like a Rorschach test for the financial community, and I couldn't stand it. So I don't know if they're going to get rid of it for good, but I was happy to see that we're getting back to the way I learned about the markets, where I had to actually look at the data and come up with a reasoned, factual playbook about what I thought was going to be happening. And if that's the case, we talked about that yesterday with Byron Anderson from Lafferty Engler. He's all for normalization too, and he knows it will take a little time, and he knows it might be a little bit painful. But we're just going to get back to people having to do their own homework.
Well, yeah, and I think investors need to know this. It's not inherently bad, it's just different. And that means the implied VIX, the volatility of the market, is going to be elevated from here on out because the Fed is not going to be as much as a crutch. That's the takeaway from it. But there's a big difference between volatility and risk. The only thing Mr. Market's worried about right now, to be sincere, is interest rates, the risk-free rate competing for equity dollars. I mean, pre-war levels, if I'm not mistaken, I just glanced, the 10-year was running under 4 at 3.9. Now we're at 4.68. That's a gigantic jump. Think of what this is going to do to housing. Think of the slowdowns. I mean, this has got real repercussions. So you're right. Honestly, if I'm going to make a call, you asked me not to, but I'm going to make one anyway. No rate hike this year because the bond market is doing Fed's job for them because the vigilantes are out. And that's why I want everyone, if you're going to own bonds, do it the right way. Permanence and definition. You need to have individual QSIPs with individual maturities or institutional funds that have guaranteed maturity dates. Otherwise, you are subject to perpetual duration risk here. Be mindful of that if you're in a 60-40 portfolio, because that 40 is going to be under pressure into perpetuity.
Yeah, right. And then so a lot of folks out there that are looking at what we're looking at and looking at the way the government's spending money and the problems that we have there, and that's why we've seen the 10-year and the 30-year doing what they're doing, have also turned to gold, even though it's at 4,000. There's some folks that really feel like because of the destruction and the tax that we're paying as far as inflation goes, that could be another place to put your money. I don't have any money in gold. I don't know if you do personally, but what are your thoughts on gold here? Because it is expensive, but that doesn't mean it can't get a lot more expensive.
No, the midterm outlook on gold remains sloppy, but you have to acknowledge that the movement in the bond market the last 2 weeks with the vigilantes out might reverse that trend and start driving gold higher, especially if this, thought pattern that the Fed's getting behind the curve on inflation, if that starts becoming not a minority opinion, but that starts becoming a consensus opinion, this is going to be an excellent opportunity for gold bugs to start getting excited again and mainstream investors to go to the drugstore, which is their advisor or their account, and start getting a little Tylenol, start nibbling on some gold here because it's not going to cure anything, but it makes you feel a lot better. And that's the purpose.
Great stuff as usual, Craig. Love having you on a Friday. Craig Bolanos, he's a co-founder and a wealth advisor at VestGen Wealth Partners. Thanks for being on the show. We'll see you again next week, brother. Really appreciate that. All right.